Hi, I'm Pattu from FreeFinCal, and in this video let's talk about how an arbitrage mutual fund works and when and how you can use it efficiently. So an arbitrage opportunity essentially means that as the same product is available at two different prices in two different markets, and you buy and sell the same product in different markets for a profit. That's the essential idea of arbitrage. Every day we see this at work, but we just don't recognize it. So let's say I'm a shopkeeper and I sell a bar of soap. Now the bar of soap has an MRP of, let's say, 30 rupees. Now I sell this at MRP to the people who come to my shop. But in order for me to make a profit, I must be able to get this bar of soap for 20 rupees or 25 rupees from the wholesaler. So the bar of soap is available at the shop at 30 rupees, and it's available at the wholesaler at 25 rupees. So that's the arbitrage or profit of 5 rupees. Essentially, it is a guaranteed profit because you buy from the wholesaler and you sell to the customer. So at different prices, and the difference in the profit is the arbitrage opportunity essentially. So, but the way it works in the stock market or in any other market, the forex market is a bit different. So I'll give you a very simple example of an arbitrage opportunity and how mutual funds use it. I've written it down on a piece of notebook. I hope it comes out correct. So excuse me if I shake it. So let's say a stock is available at 8 rupees in the so-called cash market, right? And the cash market is what we do every day. We see it in the ticker, the symbols that go by. That's the cash market. So if you buy at the current price, you get it immediately. Then there's something called the futures market. In the futures market, you will agree to deliver the stock at a price which is decided today. So let's say you will deliver the stock in 10 days time at a price that's decided today, and let's say that price is 10 rupees, right? So and then there's that spread of 2 rupees, right? And because this kind of a spread is available, the other people will also jump in at this opportunity, and the futures contract can also be traded, and because of that and the market forces, the difference in price will essentially become lower and lower with time. And when the time of the expiry comes, when the futures contract expires, let's assume the simple case that the current cash price is the stock price in the cash market is 9 rupees. So you will sell the whatever stock. So you essentially what you did when you saw that 2 rupees opportunity here is you bought, let's say, 100 stocks at 8 rupees, and you agree to sell 100 stocks on a future date at 10 rupees. So now when the time for you to honor that contract has come, the price is now 9 rupees. So you will essentially sell those stocks, that 100 stocks that you have, and get a 1 rupee profit, and then you will agree to deliver those stocks at 10 rupees, and again there's a profit of 1 rupee. So that's the profit of 2 rupees that you have locked in. That's called the spread, and that's essentially locked in no matter how these things fluctuate. So you have the same stock which is trading at different prices in different markets, and you use that to buy and sell, and then again reverse that transaction when the expiry date is at hand. So this is the arbitrage opportunity. The advantage is that if you do this kind of an arbitrage transaction with stocks, then the mutual fund will be considered as an equity mutual fund from the point of view of taxation. And that's the first part. But no matter how much the stock price fluctuates, the arbitrage opportunity essentially is more or less locked in as long as the prices converge. Of course, the prices need not converge in principle, but usually they do. And so you call it as a risk-free profit. Of course, there are some risks involved, and these risks are a bit technical for me to discuss now. I've already posted this. I don't know if I've said it clearly enough, but I've discussed these risks in a post. I'll link it below. There are some risks, but the bottom line is that the NAV of an arbitrage fund will fluctuate on a daily basis up and down, and this fluctuation will be comparable to that of an ultra short term fund. So if you look at the volatility or the standard deviation of an arbitrage fund, assuming that it does that it doesn't do any hanky panky and so on, typically, assuming the fund holds most of its holdings are arbitrage opportunities, the volatility will be comparable to that of an ultra short term fund. It will be more volatile than a liquid fund, but more or less comparable to an ultra short term fund. That is a fund which is holding bonds between something like six months to 1 year and so on. However, the big problem is that arbitrage funds can also hold bonds. And I had written in a post that 2019 will be the year in which one of the bonds that the arbitrage fund holds will default. Actually, I was mistaken. That has happened in 2018 itself. Principal Arbitrage Fund was holding IL and FS bonds, and that defaulted. You can go and see the NAV of Principal Arbitrage and how it fell down sharply. So that because of the credit risk. And unfortunately, because of the SEBI regulations, an arbitrage fund only needs to hold 65% of arbitrage opportunities. Such opportunities exist not only in the cash and futures market. There can be a dividend-based arbitrage. There can be arbitrage in the index and so on, among other kinds of arbitrage. So the index fund can exploit all that. There can be arbitrage in the debt market also. You can play using the swaps. An arbitrage fund can do all that, but the problem is it can hold bonds. It can hold anywhere between 10 to 20% or even more of bonds directly. There'll be no arbitrage involved. And if those bonds default, and if those bonds are subject to interest rate fluctuations, the risk will be higher. And that has already happened in 2018. So we have to be extra careful in selecting arbitrage funds. We should use a mutual fund that does not hold any risky bonds. It should be the bond component should be money market. It should be gilts or preferably cash. So you should have a look at that. That makes things difficult. Like I said, the SEBI rules have actually made things more difficult for the investor to select debt funds and even arbitrage funds. Now, how much return can you expect from an arbitrage fund? Anywhere, I would say 6% to 7%. The big advantage is it is taxed lower than a debt fund. In a debt fund, if you sell it within 3 years, you have to pay tax as per slab. But in an arbitrage fund, the short-term capital gain is 1 year and it's taxed at a flat rate of 15%, which says. But above 1 year, there is a 1 lakh tax-free margin for you to exploit in an arbitrage fund. But beyond that, there's a 10% taxation. So essentially, if that is the only transaction that you're going to make in the equity sphere, then definitely the arbitrage fund is more tax efficient than the debt fund. Unfortunately, I don't think it is no longer risk efficient. I used to think of them as risk free, but because of the bond problem, it is not as risk free as I thought. Of course, there are risks in the arbitrage itself, but those are minimal compared to the credit rating risks and downgrades. So, alright, so let's say I recommend 2 arbitrage funds in my plumb line list. One is UTI spread and the other is ICICI equity arbitrage. ICICI equity arbitrage can hold a little bit of direct stocks also, so you should be careful about the volatility there. So I personally I have held both these funds. I have held UTI spread or UTI arbitrage in the past. Now I am holding ICICI equity arbitrage. I use the arbitrage as my debt component, tax efficient debt component for a long term portfolio. So I have a part of my son's education portfolio is in arbitrage, in ICICI arbitrage. So if I want to rebalance, I can actually pull it out and switch it back into the equity fund and so on. That's how I use it for. An arbitrage fund can also be used as a component of your emergency fund. Let's say you are paying an EMI and you're worried that you might have to change jobs or there's a problem in your job. You can take about 3 months of EMI and put it in arbitrage fund. So that's only for the EMI. The rest of the emergencies can be in cash and liquid funds and fixed deposits and so on. That's for normal emergencies. But in case you want to, pay off your EMI for a couple of months in case there's a job switch and so on. Of course, you can use a overdraft home loan for that, but this is also one way if you would like to do that. So you can use it for long-term goals. You can also use it for short-term goals. You can also use it for goals that are a couple of years away. Sorry. But don't use arbitrage funds for short-term, very, very short-term, like 2 months, 3 months, less than a year. Don't use it for less than a year. It can give you negative returns less than a year, even if there is no credit rating problems, because of the arbitrage opportunities themselves. Some of them can go bad, some of them can, like I said, the price convergence in the cash to futures market may not happen as planned. It can diverge again during the expiry and so on. It can go the other way. There are problems like that. There one more risk with arbitrage, which I hope no Indian mutual fund does, is that they will buy and sell different stocks in the cash and futures market. That kind of hedging is very dangerous. And if the price does not converge, and it is very unlikely to if you hold the different stocks, and if there's a huge spread at the at the time of unwinding the arbitrage opportunity, there will be a big loss. This has happened before for a very popular mutual fund, I think, but not Indian mutual fund. So far, I don't think we have that problem. So these are the aspects of an arbitrage mutual fund. They are not simple products to understand. There are different kinds of arbitrage. I don't claim to be an expert. I just know a little bit of what is going on. But you've got to be a little careful when you do it. But as long as your need is longish term and you're buying a mutual fund which does not hold risky bonds in the arbitrage fund, I think you should be reasonably okay. You can also use an arbitrage mutual fund to generate income. You can simply draw money out from the arbitrage fund. There used to be a dividend option which was attractive because the dividends earlier were tax free. Now they are taxed. So instead of that, you can hold put some 50 lakhs in an arbitrage fund and just draw out money whenever you want. You can ensure that the capital gains is less than 1 lakh, so it is always tax free, or it doesn't matter if you keep drawing, you pay the tax, but the tax will keep increasing as the units come down. I have a post on that also. But the problem is that when you derive such income from a mutual fund, the principal amount will go down. You are actually depleting your principal amount. Whereas if you get interest from a fixed deposit, the principal will remain the same, but will be, of course, devalued